A very good morning to all of you, dear investors. My name is Nimesh Mehta, and on behalf of ASK Investment Managers family, I welcome you to this exclusive webinar with our investors. To kickstart this initiative, we have with us today the Executive Director of ASK Group, Mr. Bharat Shah, or Bharat Bhai, as popularly called by all in the industry. Today's webinar is going to be for 2 hours. In the second hour, Bharat Bhai will answer all your questions. So request each one of you to type your question in the public chat or private chat box below. We will take it up in the second hour. The first hour is split into 2 parts. In the first 30 minutes, Bharat Bhai will share his thoughts on the equity market. And in the next 30 minutes, he will share ASK's philosophy of investing and also share an update on ASK portfolios. Without taking any further time, I request Bharat Bhai to share his thoughts with all of us. Over to you, Bharat Bhai, and thank you for your time.
Thank you, Nimesh. Good morning to all the participants. As Nimesh said, let me put first session into where the Indian opportunity and where it is lying, where the future is kind of beckoning us. The second part, I would talk about what is very dear to us, our investment philosophy, our approach, how we tend to view investing and what we seek to get for all the valued clients, you all there on the call. Third, I would touch upon some of the highlights and let me put some light on the current year 2022, which has not been very kind to us in terms of our performance. And very candidly, I would like to bring about whatever are the issues that we understand and we think. And lastly, I'll be too glad to answer all questions and queries and posers and points that you may have. So with that, Nimesh, can I move ahead on this?
Yes, sir. Perfect.
Okay, sure. So let me first talk about where we stand. And I think we are standing at a historic moment. And when I'm saying this, I mean it with a full sense of responsibility. I believe we as a country, India is stock markets and investing as an opportunity is at a vantage point of kind of long-term opportunity that probably comes once in a lifetime. And every inch of my body tells me that what we are staring at, not just a short period of 2 years and 3 years or 5 years, but probably 10 years and 15 years and 20 years ahead of us promises to be really a golden period. About 3.5, 4 years back, I wrote an article in Economic Times, and the article was titled as The Golden Decade of India. If I have to write the same article today, because when I wrote that article, some people felt that some of the points were, rather early. Also, in some of the aspects, people felt were presumptuous. Maybe they were, but if I have to write the same article today, I would make only a small modification. What I described as the golden decade of India, I would today say it is golden decades of India. And that is the kind of all-consuming passion and belief I think we as a country today are standing at a vantage point. The last 7-8 years have witnessed tremendous amount of reforms and tremendous amount of changes. Some hugely successful, some are still work in progress. Some got introduced, but it had to be taken back due to the pressure of the system. And some others are still in the offing. But what all these changes are doing is something gigantic at work. Each individual change in itself has some impact. Each reform in itself has its own effect. But when you build an ecosystem of the reforms, when you build a large number of changes and deep reforms, many of them together, then the impact is not arithmetic sum total of each reform, but it becomes a kind of a geometric multiplication of those reforms. And therefore, I would say today we have built a capacity and capability of the economy to grow at a rate which is by any historic benchmark probably the highest. And I'm saying this with a sense of responsibility, given the backdrop that the world is in. The rest of the world, or large parts of the rest of the world, is actually into deep difficulty and deep challenges. And therefore, the Indian opportunity seems surprisingly in a contrast. And therefore, with a full recognition of that contrast, I'm saying what I'm saying. That doesn't mean that there will not be volatility on the way. That doesn't mean there will not be violence also occasionally. Fluctuations, volatility, violence occasionally are part of the markets. And no matter what you do, however great a journey may be, however large eventual destination may be, markets invariably through that journey will produce its own violence, its own volatility, its own moments of joy, and its own moments of nervousness. So nothing, all of that will remain as we move ahead. There will be time to time, there'll be pangs of doubt, there'll be a lot of concern, there'll be periods of undiluted joy, and there'll be periods of sobriety. But I believe through that ups and downs, through that volatility and occasional violence, we are standing at a cusp of one of the greatest opportunities in this country that it always was capable of, but was denied to us because structurally we had too many weaknesses in too many areas. And therefore, we were never able to create a sustainable, predictable kind of a future. Therefore, changes which have come are not shallow, but deep. They are not short-term, they are long-term. The impact will not be minor, it will be huge, and outcomes will not be arithmetic addition, it will be geometricity compounding. And that essentially, I think we have reached the stage where as an economy, fundamentally, we have built a character and capability to grow on a sustained basis at 7.5%, 8%, even probably more. That doesn't mean necessarily we will grow at that rate every year. There'll be periods where there'll be up and there'll be periods when it will be little lower. But essentially today we have built an economy, a bedrock where 7.5%, 8% kind of a long term. When I say long term, I mean 10 years, 12 years, 14 years kind of growth, which is distinctly possible, given the fact that the world is in challenge. Exports cannot grow in the same way as it is doing for last couple of years. And therefore, we may choose to grow at a little lower rate, though our fundamental capability as an economy today, I would say, is distinctly at 8% and more on a sustained long-term compounding basis. Therefore, as a prudence, as a wisdom, we may choose to grow maybe a little lower. That is because not to create ruptures or pressure on the exchange rate, pressure on the economy because of the external world, not because of internal situation. With that caveat, let me say what I believe is the picture ahead. I believe economy on a sustained basis will deliver initially at about 7.5% kind of a rate. And as the rest of the world recovers and gets into a better situation, I think our rate of growth will improve. Of course, there will be yearly and seasonal volatility in these growth rates, but direction, overall magnitude of the growth will be that. That in turn will reflect into the performance of the quality businesses, the businesses with character, businesses with moats, and therefore there will be tremendous value creation by quality businesses. It will also reflect into the performance of the value creation and the wealth building by quality and honest entrepreneurs and the managements. And indeed, investors who are patient, who are long-term, who are disciplined, and who are wise will create wealth of a kind which is unprecedented. The economy itself, the changes that we have brought about and are still in the process of building, it is not about merely the rate of growth. Even more important ideas are clarity of the growth rate or the confidence that growth indeed will occur. When there are two businesses, let us say, with the same growth outcome over a period of time, but in one business you can predict and you can be confident that indeed that growth will occur. In the other one, you are tentative and unsure, even though both of them may deliver exactly the same growth rate over a period of time. But the business with predictability would have a greater value. Despite the fact that both may produce the same earnings and the growth after a given period of time. Therefore, predictability has effect of improving the value of a business. Certainty of the growth has an impact of improving the value. The simplicity of that growth and ability to understand has an effect of improving the value. And durability of the growth rate, when the growth becomes longer term, rather than for a shorter duration, the impact of the same growth rate but over a longer period becomes geometric compounding outcome, and therefore value of that business becomes much, much higher today than a business producing same growth rate but for a lower period. And therefore, I think we are in the cusp and in the midst of many of these changes. Let me summarize some of these. There are too many, and I can't cover all of them, but I'll try to cover significant ones at some level of detail. And then I'll move over to the second area, which is the way we think about our investing, the philosophy. The first big change which has occurred is the bringing down of the cost of capital. That is deep changes, deep impact. It has impact on the business profits. It has impact on the quality of the lending by the lenders. It has impact on the lending volumes. It has impact on the asset values. And the victory that we have attained in bringing down the cost of capital over a period of time is not a matter of chance or a happy accident. It is not a happenstance. It has been achieved by discipline, systemic, fiscal, and monetary reforms which have been carried out over a period of last 5 to 6 years. And therefore, it is not an accidental outcome where the world or so-called developed world of America and Europe is actually behaving like developing world and running helter-skelter to keep raising interest rate in a random way. In that backdrop, India has achieved through structural changes on the fiscal and monetary part, a reduction in the cost of capital. And therefore, that fact and the attainment and achievement of India is not lost on anybody, including the most developed nations in the world. They all recognize that something that we have done is indeed dramatic. Second, if you see the banks, they had very, very poor balance sheets over the years of neglect, bad loans which were given either out of mistakes or out of malfeasance. And the whole banking and the lending system in general was laden with unbearably high level of bad assets. ILFS episode in 2018 was a wake-up call. Subsequently, Yes Bank and Diwan Housing and other such episodes. Really, it is a great credit to government and to RBI that a huge amount of write-offs were forced upon the system starting from end of 2018, in 2019, then 2020 pandemic led further write-offs, and then second wave of pandemic in 2021 further write-offs. Today, banking and the lending system is in pink of the health with strong balance sheets. Many of them have raised equity, therefore their relative debt levels are modest too. And their asset quality is squeaky clean. Therefore, banking and the non-banking lending system today has capability and strength to lend in a healthy way, in a resounding way for a long period of time. I would say we are clearly in an era where 15, 16, 17% compounded lending volume growth is something which is going to occur for a long period of time. And the lending system is strength and infrastructure to be able to do so. Third, borrowers have become, their balance sheets have become sound and solid. March 31, 2020, if you look at the debt equity ratio of the corporate India, it stood at 75 paise of borrowing vis-a-vis 1 rupee of net worth. 0.75:1 was the debt equity ratio. 1 year later, March 2021, the same debt equity ratio has come down from 0.75 to 0.4, 40 paise of borrowings to 1 rupee of net worth. Therefore, not only lenders have sound balance sheets, borrowers also have sound balance sheets today, and therefore capability and capacity to borrow. Earlier, lenders were chopped and they had no capability to lend. Borrowers were chopped because they were laden with debt-laden balance sheet. and servicing obligation. Today, both have become decloaked. This is a big, big change for the long-term sustainability and growth potential. Fourth, the digital revolution. And truly, India is at the forefront of that. Digital wedded to finance, to logistics, to agriculture, to health, to education, to manufacturing, will produce magic of a kind that this economy has not witnessed so far. Digitization is a way of making us lower cost economy, and I think I indeed believe we have entered an era where for the length of time we will become reducing cost economy rather than incompetitive rising cost economy as was the case earlier. Also, digitization helps in serving customers better, attaining scale faster. They not only reducing cost and improving capital efficiency, but delivering that scale in an efficient and effective way and creating operating leverage. And that also in turn is able to create a rising capital efficiency. All of these will have deep impact in terms of the corporate outcomes, their profits, their return on capital employed, return on equity, and therefore the value of these businesses. And indeed, not only corporates have reduced debt equity ratio in the pandemic year of 2020-21, but have also since then raised return on capital employed and return on equity of the corporate sector. Therefore, we have become not only financially stronger, but in terms of the business capability, we have becoming stronger. Fifth is the revolution on the payment side. And that is taken note of today by everyone in the world. 2016, November demonetization, May 2017, United Payment Interface, the first revolution on the payment side launch. What was a beginning of something important has become dramatic one now. And today, India has become #1 digital payment processing country in the world, some 61, 62%, and number keeps rising, is digitally processed in India. And only in a matter of 5.5 years that has been achieved. When you look at these numbers in China, it is at about 30%. In America, it is at 20% or so. In Europe, it is in single-digit number. And therefore, mind you, China began on this journey 15 years back. India started only 5.5 years back. And yet India has taken a clear global lead. This payment revolution has its own story to tell because you cannot have a rising economy with archaic payment system. And therefore, digital payment system will help in sustaining and accelerating the economic growth. The sixth part, the startup ecosystem and the revolution that it is brewing. It is already the third largest startup ecosystem of the world, the most vibrant one. And impact is threefold. New entrepreneurs, second, new innovations, and third, new business models. All three are vital for value creation. Granted, some of the startups will fail. Some startups will fail probably miserably. Some will guzzle away capital and destroy value, but enough will succeed. And enough will throw new wave of entrepreneurs, new business models, and new set of innovations. And therefore, these are at a root for value creation. And indeed, entrepreneurship is one factor which distinguishes India from let's say, Europe or America or most of the South Asia. And therefore, Indian entrepreneurship, which is now unleashed, is one of the greatest sources of value creation opportunity for the country. That brings me to the seventh part. Government has made its intent very clear. Government doesn't want to run businesses, doesn't want to start new businesses. Slowly it will unwind what it has got, except some very strategic area. Politically, it's a touchy subject and therefore it will take some time. But government clearly is not contesting and competing with the private side. Government is busy putting the rules of the game and setting the architecture of the game, but government doesn't want to be a player itself. This is important because when government is not a player, it sets in place the motion of the entrepreneurship. Because when government is both a rule maker and a player, then the private players are muddled and are confused as to how to play the game. Therefore, this will unleash one of the biggest waves of entrepreneurship in this country, which it was always capable of, but was shackled. And now I think that is getting loosened up in a huge way. Ninth, the speed, the quality, and the strength of the physical infrastructure that we are building. In last 7 years, we have built 53,000 kilometers of new roads. And mind you, some of the roads and the bridges that we are building are world class. These are projects of complexity and character of a kind that have not been attempted in many other parts of the world. And therefore, it is not merely new roads that we are building, which is the record, but it is the quality of that infrastructure, which also is a noteworthy feature. In the first 67 years of this country's independence, we had built 72 airports. In last 8 years, we built 64 new airports, almost same number of airports is what we did in the previous 67 years. If you see the coastline on the west and on the south, every single important point on the coastline has been strategically built and converted into a transshipment point from a coastal and from the point of view of the coastal transport. Railways is another one where we are rapidly building both scale and character and capability and efficiency so that it becomes a powerful driver of the growth. This will stand in great state for industry and manufacturing because without a quality infrastructure, industry and manufacturing suffers. That brings me to the 10th point, the logistics. Today, logistics cost in India is about 13-14% of GDP. Government is recognizant of the fact and it is taking steps so that over a decade, these numbers can be brought down from 13-14% to half that percentage. And in the period, GDP itself will rise. Therefore, the twin effect of rising GDP and the falling logistics cost as a percentage of the GDP will produce huge amount of additional profits and efficiency booster for the businesses in terms of their competitiveness. 11th, if you look at the energy blueprint, one of the most important areas. Today, we are materially dependent on hydrocarbon energy as a key source. But we are rapidly building the renewable energy portfolio. In fact, India today is boasting of the biggest renewable energy portfolio to be built in the next 5 years. We are building about 350,000 megawatt, a gigantic portfolio of 3,350 gigawatt of new renewable energy portfolio, the biggest in the world. Even more incredible is, apart from the biggest renewable energy portfolio in the world, the biggest hydro H2 project or the green hydrogen projects, the two biggest green hydrogen projects or H2, both are being built out of India, out of the 4 projects in the world. And the 2 being built in India are the biggest, with the financial closure done, projects at varying stages of progress, while the 2 other global projects, one in China and US, both are uncertain, unclear, and no tangible progress on any projects has occurred. And therefore, India, without any doubt, will emerge as the global leader in H2 and in the green hydrogen in the period to come. This will have deep impact on import substitution of hydrocarbon, ammonia, which is a huge area of import. 85% of ammonia is imported, very strategic resource. Green hydrogen will create that ammonia and therefore will eliminate that import part. The urea, which is a byproduct of ammonia, again is more than half of urea is imported, and vulnerability, and therefore green hydrogen will pave the way for even urea being made within. And therefore, that brings me to the 12th point. Systematically, if you see, each major area of import and each major area of export, government is working a blueprint to reduce imports and to be able to boost exports, whether it is hydrocarbon imports, edible oil imports, or imports of the consumer durable or mobile phones, where we have achieved remarkable success. In 4 years' time, India has become second largest producer of mobile phones in the world. 4 years back, India was importing about 10,000 crore of mobile phones every month. Last year, India exported 28,000 crore of mobile phones. September month alone, India exported $1 billion of mobile phones. And therefore, systematically, many areas of imports and many areas of exports are being identified and processes run to boost the capability in each. Among the last 2 points, the PLI-led manufacturing is one other great reform the government has taken. 19 sectors have been identified, which are of strategic importance, where entire value chains are being built, and the manufacturing is encouraged at a scale, not only for local, but also for the international market. As these processes run through, and these have been built very beautifully in consultation with the industry, and therefore I think Indian manufacturing prowess and renaissance, which was withering earlier under the assault of imports, finally has a full chance to bloom and to become a source of the strength. China plus substitution, which was at one time merely a customer risk reduction strategy, then it became a source of a deep concern for them. Then it became a priority item, and now it has become an alarming urgency for the global customers to move away from China. And there is only one country in the world, which is India, which has a potential to, at a scale to substitute or to provide a meaningful foil to China. China is not going to go away, and it will remain large and significant, but significant chunks of that activity is coming India's way, and it will be a source of major growth. One last point, 2 last points. Transparency. GST is formalizing businesses and boosting capability. RERA is boosting real estate transparency and boosting that industry and creating new demand. Insolvency, bankruptcy process is solving business failures and ensuring assets are reutilized rather than remaining inefficiently unused. Direct tax reforms with transparent faceless assessments, digital indirect tax assessment. Transparency is not merely socially desirable good that it is. Of course, it is socially desirable, but it is an economic good as well. When the money is not in the bank lockers or under the pillow, but in the system, that money has velocity and therefore it has capital efficiency. Therefore, economic efficiency of the system improves. When money is locked up in the safe deposit lockers of the people or lying under the pillow, that money has no further capital productivity. It's like a dead good lying around, and therefore it hurts the overall economic efficiency of the system. Finally, the self-belief and confidence. Look at the way this country has handled pandemic. Today, after 2.5 years, we can objectively take a look at, rather than emotionally, how things have panned out, how the world has handled, including successful economic country blocks like America, North America, Europe, prosperous parts of Asia, how they've handled, and how we have handled with limited economic resources to spare, limited health resources in the public arena to spare, large population, congested living, small houses. This pandemic could have been a huge, insurmountable kind of a challenge. But look at how fantastically today we can say we have handled. And look at what China is going through. In a way, it's a poetic justice, probably, because that is the country which probably has commenced this all. The way India is handled, I think the credit belongs to the whole nation, to the government, to the people, to the businesses, and to the entrepreneurs. Everybody has a reason to the challenge and made something which looked like an impossibility and uncertainty of a gigantic proportion into a fantastic, favorable outcome for this country. This self-belief is vital. Without self-belief, there is no confidence, there is no optimism. Without optimism, you cannot build future. Without optimism, neither there can be new investment in businesses. Without optimism, there can't be investment into the markets. And therefore, optimism, self-belief is a very powerful idea. And I would say that asmita, that self-belief, that confidence is something in this country today in a state of very strong, happy confluence. I've just narrated some of the big economic reforms. There are many more reforms which have been done, are in the offing, are in the work in progress. But today we have built an ecosystem of so many reforms. Together they're combining into a symphony whereby it is leading to deep economic changes. It will reflect into the performance of quality businesses. It will reflect in the wealth creation by quality entrepreneurs, honest entrepreneurs. It will reflect into the wealth creation by investors who are long-term, patient, wise, and disciplined. And therefore, I think this is a once in a lifetime opportunity for next 5 years, 10 years, 15 years, and 20 years of a kind that this country has not witnessed before. I'll move to the second part, our investment philosophy, our approach. I'll take only about 10 minutes to conclude on that, and then 10 more minutes to talk on our portfolios and the performance. And then we'll have the floor open for questions. Philosophically, investing is art and science, and both are very important. But art, I would say, in some sense, is a little higher than the science part. Science of the investing pertains to two levels, at a stock level as well as at a portfolio in its entirety. And both are critical. Once the science part of the investment or the portfolio building is over, kind of art overtakes the picture from there. So let me first talk about the science part. And within that, talk about individual stock level. At any individual stock level, essentially, you want to eliminate sources of risk. And what are the critical sources of risk? Or in other words, what are important enablers that you want to see positively there so that that risk is obviated? The first important enabler that you want to see is the quality of business. Very, very few businesses have the character, have robustness, moats, and longevity to be able to create meaningful value, superior value, durable value over a period of time. I would say barely single-digit percentage of businesses of all kinds, anywhere in the world, whether sole proprietorship or companies, whether listed or unlisted, whether large or small, in India or America, single-digit percentage of businesses anywhere in the world have really a character and capability to create meaningful, durable, significant value over a period of time. Second, you want to see the character of the management also, both ability as well as integrity, foresight as well as execution, capital distribution as well as capital allocation, philosophy, culture, institutionalization of the business, resilience, fire in the belly. Many important ideas are all that are integral to character and quality of the management. Again, barely single-digit percentage of all businesses anywhere in the world have a character of management which you can trust and rely upon. Third is the size of opportunity. Is not a statement of fact about the past or today, about how large a size is. It's a statement of conjecture, an opinion into the future about how large something can be tomorrow than what it is today or was yesterday. It is that which is very, very important and very critical, because without the size of opportunity, tomorrow cannot become bigger than today. And investing in a business is all about becoming bigger tomorrow than today, because investing is nothing but putting X amount of money today in a business which is going to become X plus Y tomorrow. So the difference between X plus Y minus X today, or Y is in your pocket as investment return. Therefore, size of opportunity is very critical. The size of pond rather than the size of the fish is a way to look at it. The fourth important enabler is the growth. Without growth of a business, its earnings, its cash flows, a business cannot create value. Nothing in the law of the nature, nothing in the system remains the same without change for a long period of time. Nothing can remain static. If it remains static, it will actually regress and come back. Therefore, growth is an essential character. Without growth, businesses actually retard and regress. Therefore, growth of our top line, of the bottom line, of the cash flow is a vital idea. But apart from that growth, what you need is the quality of growth, predictability of growth, certainty of growth, solidity of the growth. What I was referring to at the beginning about the economy. The fifth factor, which allows growth to convert into an outcome larger than the growth as a reflective returns, is the quality of growth. Quality of growth may be intangible, but a very real number. It is the quality of growth that makes growth without friction to convert into an outcome that you desire, which is the investment returns, into equivalent or higher. Therefore, logically, future growth of earnings, let's say to simplify on a per annum basis over a period of time, is a one source of return, investment returns that you make. Long-term future growth of the earnings is equivalent of long-term per annum kind of compounded returns that you make out of that investment. Second is the quality of growth. If the quality is superior, it will aid further to that earnings growth. If the quality is even, it will neither aid nor reduce. But if the quality is inferior, it will take away from the rate of growth something. And therefore, the investment returns will be lower than the future, let's say, per annum earnings growth. And if the quality is downright rubbish, corrosive, actually the growth will, rate of growth of earnings will result in negative value creation. More it will grow, more it will destroy and reduce. Therefore, quality of growth is a very powerful second source of returns, apart from the earnings growth is the first set of return. Earnings growth in the future is the cake that you are looking forward to. Icing on the top of the cake or the cherry on the top of the cake, again on a per annum basis, is the quality of growth, the capital efficiency, return on equity, frictionless conversion of the growth into returns is what the quality of growth is all about. Intangible to most minds, maybe unseen to most minds, but a very real and even a bigger factor than the rate of growth of earnings. Finally, the margin of safety, which is the gap between price today of a business and its intrinsic worth today. All the aspects of the science at a stock level, the character of the business, the character of management, the size of opportunity, the earnings growth, the quality of growth can be converted using the mathematics and the science of investing into an opinion on the value of a business. Why is the value opinion important? Because eventually price has to be equal to what the value is. Even if at a point of time, price may be different than the value, but over a period of time, price has to be equal to the value. Again, it may diverge, but time to time, the two will meet together. And therefore, if you can predict future value, you know the future price. And if you know the today's value, you can compare today's price and see whether you have a margin of safety or not. Therefore, the third return that you make in an investment is from the margin of safety. First return is an annuity, future earnings growth. Second return is the quality of the growth, again an annuity. Third return is a one-time return. If the price today is cheaper compared to value today of a business, say 100 rupee value in your opinion, and the price is 90, you have one-time extra of 11% from 90 to 100 is a one-time extra over the period of investment. Therefore, let's say a business will grow, earnings growth at say 11-12% in future, in your judgment, and if that judgment is right, let us say quality of the growth is superior, it will add say 1 or 2% further on a per annum basis. And let's say you bought that business at a 10% margin of safety. So you get another about one time 11% spread over, let's say 8-10 years of investment. It will give you another about 1% extra per annum. All the three put together then can give you eyesight of maybe 14, 15, 16% long-term compounding of that investment. This is the science part of investing. At each individual stock, you want to eliminate any source of risk, or you want to catalyze the enablers in all of them together, not some being there and others being left out. All the enablers have to be in place. And therefore, getting management quality, business quality, size of opportunity, rate of growth, quality of growth, margin of safety, all have to be in place so as to eliminate many sources of risk. And in other words, it gives you foundation for making real, solid, predictable, long-term investment returns. Second part of the science of investing is at a portfolio level. What you are doing at each stock level, you want to do it at a portfolio level, as if the whole portfolio of, say, 20, 25 names, as if the whole portfolio were the single stock. How you would apply risk control and risk management, and how do you impart all the same characteristics that I talked about at individual stock level, you want to apply at a portfolio level, so that the two together, the portfolio in its entirety also has a risk control. Each individual stock is like a note of music in a symphony, and portfolio in its entirety is like a symphony put together. Each note has to be sound and sweet, therefore it blends with the symphony, but the entire symphony or the portfolio has to be built with a due care and character, so that the portfolio has a character of its own, and each note of the music blends with the symphony and creates beautiful music rather than a cacophony. Therefore, when you complete it at an individual stock level and at a portfolio level, you complete the science part of investing. Then comes the art part of investing, which is essentially three elements: discipline, the wisdom, and third is the psychological strength and resilience. Discipline is basically what the science tells you or the intellect tells you to do it. Intellect can tell you what is the right thing to do, but intellect cannot ensure that you will do the right thing. It is discipline, the internal mindset or the character of the individual, which is very vital, that not only you know what is the right thing to do, you not only know what is the science of investing, you actually do it with discipline. That you don't get carried away by bad businesses. You then don't get carried away by phases of the markets when bad things get rewarded and good things may not receive attraction. Ultimately, destiny of every good business and bad business is predetermined. Bad business eventually will decline, diminish, and die, and a good business eventually will rise and ascend and create a crescent. But before a bad business declines and dies, there may be many false honey traps where it may rise. And before the good business rises and goes up and above, there may be many false signals where it may fall and may create scare and worry. Therefore, before bad businesses die, they give life and hope and a huge amount of sudden blazing glory. And before good businesses rise, there may be many moments of worry and concern. And therefore, discipline to do the right thing, discipline to buy quality, and to buy quality at a fair price, and to remain committed on a long term is a very important part. Second is wisdom. Wisdom is not only to realize what intellect is to say, not only to convince internal mind and the heart to act with discipline, but to be able to do it not once or a few times, but time after time. Wisdom is an act of discipline in eternity, not once in a while or occasionally. And therefore, it becomes the second nature of the individual. Third is psychological restraint, resilience, serenity, calmness, and an ability to not get unduly impacted by the market behavior. Markets have always been volatile from time immemorial, sometimes more, sometimes less, sometimes with violence on the upside, sometimes with violence on the downside. But volatility is a recurrent phenomena. Violence is a sufficiently recurrent phenomena, but occasional. Therefore, volatility is forever. In between, there will be periods of violence, both on the up and on the down. This is the nature of the markets. Once we recognize that markets will do these things, we have to calmly accept it and not get carried away by the market behavior. There may be periods when you may do the right things, and yet markets may make you look foolish. There may be periods when you may do actually a foolish thing, but markets may reward you with ungratifying kind of a result and may make you look like a genius, even though you may made an error. But neither one should get diffident when you do the right thing, but it doesn't give you the result immediately. Nor you should get carried away when you make a mistake and yet you get rewarded. Therefore, when you recognize that you made a mistake, you must immediately correct rather than staying with that mistake. And therefore, the psychological restraint and resilience is ability to observe market like a detached observer while being a player in the market. As a player, you are part of the market. You are investor there, and therefore ups and downs of the markets affect you. Psychologically, they create a bearing on you, but as a detached observer, as a reflector of the events, you have to not get carried away by the market behavior. That ability to remain detached, yet attached, ability to observe, yet not get influenced, ability to trust, yet doubt, ability to believe, yet a skepticism is a very important psychological capability and a mental restraint that you need to have. Otherwise, markets will put you in a false traps by jacking up unworthy businesses to high prices and trap you into buying them. And markets may make you diffident and neurotic by pushing down good businesses time to time and making you self-doubt or go into the loathing mode and make mistakes. Both the mistakes have to be avoided is a very vital part. Time to time, markets will humiliate, will impose a hurt. At times, it will impose insults. And as an investor, one has to learn to stomach it, to accept it with humility, with folded hands, and yet keep doing one's karma as one must do. Not to get distracted, not to get carried away, not to get arrogant, at the same time, not to get, not to become a waffling, falling by the wind with every change of the wind. Therefore, arrogance is the worst crime that you can make in investing, and markets sort you out. But lack of any belief and lack of any philosophical strain equally is a very dangerous thing in investing. Therefore, philosophically, investing is not timing, it is not index predicting, it is not riding on a theme, it is not geopolitical ideas, Ukraine war and America and Fed and whatnot. It is not even about macroeconomics, whether India or world. Investing is pure and simple, bottom-up art of stock picking, paying attention to the various factors that I mentioned, ensuring similar care at a portfolio level, and to keep doing the right thing with discipline, with wisdom, with psychological restraint, not to get carried away, but to remain observant, to remain agile, to remain humble student of investing, and to carry on with the path. This is what investing boils down to. One last part there. Investing is all about absolute. Though to most people, it may look relative. I'm not saying relative is not important. Relative to the market, relative to the peer set, time periods, all these are relative benchmarks. But in purity of investing, ultimately you do investing in order to build wealth, in order to make actual superior returns on an absolute positive basis over a period of time. Therefore, purity of investing is about absolute. And all that I talked about, the investing, the filters at a stock level, risk control at a portfolio level, wisdom, discipline, and psychological restraint overall is an art part of investing. All these have to combine together in order to be confident, in order to believe that without any help of Mr. Market, we will deliver an absolute positive, healthy returns over a period of time. All that you need is a reasonable period of time through which market machinations, ups and downs, volatility, violence, trips, and excitements run through, so that markets run through with all those ups and downs and changes, and over that period, in smooth, calm, serene waters, eventually you have to deliver absolute, positive, healthy returns. The beauty of investing is when you focus on absolute, relative superiority also becomes an essential byproduct. That is an essential byproduct of good absolute investing. When you focus on investing, the relative superiority of return also will come. If I have to give an example, our oldest portfolio at ASK, which now we are running for little over 20 years, the first portfolio that I commenced when I joined the business about 21 years back, was the growth portfolio. Over these 20-year time frame of that portfolio, 3 huge drops in the market occurred. 2002 or 2001, Nifty lost 58%. 2008-9, Nifty lost 68%. Mid-cap index 74, small cap 83%. Pandemic, March 20, in a matter of days or weeks, Nifty lost 38%, mid-cap lost 46%. Apart from these 3 dramatic drops, there have been 3 other periods when markets lost 25% or more, despite 3 very violent periods and 3 periods of sufficient scale where 25% plus drop. That portfolio over 20 years has compounded at roughly about 20% compounded per annum. Over that time frame, even the index has done very well at close to 12.5%. But the portfolio on an absolute basis has delivered healthy double-digit returns, and on a relative basis has delivered superiority over benchmark at about 7.5% compounded over a 20-year period. And I would say those are very gratifying results. I'm not putting any benchmark for the future, because 20% compounded is a tall order and not an easy number to achieve. 7.5%, 8% again as an alpha is a tall order, but I definitely believe there is an opportunity in the environment, in the country, in the economy, in the businesses, in the markets, to make a healthy, absolute, positive, double-digit, long-term compounding returns, as well as if we are investors of any strength and capability, we must have superiority of that number over the indices. Therefore, we remain deeply committed both to healthy, absolute, positive returns over a period of time as a compounding returns, as well as alpha or relative superiority of return, whether time will tell whether it will be 2%, 3%, 4%, 6%, 8%, but definitely healthy alpha is something both is a possibility as well as our duty to achieve if we are investors worth any salt. Therefore, we remain deeply committed to both these ideas. Finally, 2022 has been a difficult year, a challenging year for our portfolios. We have been at it all through because we have been on edge. Not that we want to do any short-term thing, not that we want to jump around chasing new themes or short-term trends or short-term popular sports. We want to remain agile. We want to remain watchful. Whether there are things in the market that we should have done, but we missed out doing, and therefore we should have been careful enough to include it. There may be things in the market which may be doing well, but what may be short-term popularity may come at times with long-term disastrous results. We want to skirt and avoid such areas, even if however popular it may be in the short run. Equally, we want to be mindful of the businesses that we have avoided, and rightly so, where avoiding those businesses has actually helped, and we want to remain disciplined on that path to observe and figure out whether what we are avoiding have been judicious and right or not. And equally, there are things that we may have included, but we should have avoided, is also something that we are watching carefully to learn lessons and to see what we must do. 2022 compared to previous 20-year period remains a bit of an underwhelming year for us. Without any question, our results have been below the indices by a good margin. It is certainly not to our satisfaction. Certainly it is not to any delight. It cannot be. At the same time, it is always a phase which is more humbling, more making you work hard, and more observant. There are things which have happened in the market and which have done very well, but on a long-term philosophy, long-term basis, we still would not like to participate. For example, commodity businesses, metals, many such businesses did exceedingly well for a length of time last year and part of the current year. Many of the metal stocks went up 3 times, 4 times, and then they have lost 40%, 50% from there. But we see these businesses with weak economics, weak characters, and weak predictability, and we have observed it, we have looked at it, but we have consciously chosen to give it a skip. The PSU businesses have done wonderfully well in the current year. Even if you look at, for example, PSU banks in the previous 10-year period, or even 15-year period, most of the PSU banks, except one, have made negative returns for 10 years and 15 years. Negative returns. Therefore, 2022 is a special year for PSUs, where across the board, many businesses have done wonderfully well. Again, we have taken a note of it. We are observant on that space. And for example, banks, we have looked at very closely. We are yet not convinced, maybe rightly, maybe wrongly, but we are yet not convinced that these businesses will produce sustainable, predictable, quality economics in their businesses over time. Until till we are comfortable about that, till we are confident about that, we do not want to jump into buying these businesses simply because they've done well. And there is a lot of feelers that they will continue to do well. So we are observing, we are analyzing it closely, but as yet, all the analysis of the past history, all the philosophical angles, yet have not convinced us that this is something durable. And therefore, when reversals come in what is not durable, equally are very painful. And therefore, at a great injury to our ego of whatever variety, we still have not participated. We continue to observe. Then there are businesses that we have bought into and which have not done well, or rather have produced a lot of pain. So, for example, a business like Metropolis Healthcare, a very well-run diagnostic chain, has right long-term points in its favor, but suddenly the way competitive situation, new players have emerged, the price wars which have been going on, and a lot of noise in the space have resulted in a high quality, high ROC, quality governance driven business, and where long-term growth about diagnostic industry is not in doubt even today. Yet the business is done miserably badly in the market. So we have suffered in a business like this. Then there are very high quality businesses that we are into for a long period of time. Bajaj Finance, for example, we have been with the investment for 12 years today. 12 years back, the market value of Bajaj Finance was 3,000 crore. The current market value of Bajaj Finance is about 390,000 crores, about 130 times. And so it has done phenomenally well over a 12-year period. But if you look at last 1 year, Bajaj Finance stock is virtually where it is. It has not gone anywhere. It is flat. And in the same period, many PSU banks have gone up 2 times. Some have gone up even 3 times. And therefore, contrast is very, very galling and deflator of any ego for us. We continue to do our work. As recently as 4 days back, I spent half the day meeting with the Bajaj Finance management in their office, along with my colleague. And we are even more convinced than ever before that a huge amount of further value creation is lying ahead of a business like this. So there are times when we may have chosen a good business, but it may have suffered. So Metropolis is an example of that. And there are some more. There are high quality businesses which we've been holding for a very long period of time. They've done wonderfully well for a huge period of time. But there are periods of air pockets. At the time when we hit a period of air pocket or air bubble, our analysis is not based on the past, but about whether from here we have reasons to believe whether it will continue to create value or not. It is ground zero budgeting, not about the past. Then there are things that are doing well, but we are not part of it. That should produce jealousy. but we don't suffer from jealousy, let me assure you. We are watchful, we are watching, we want to get a right lesson. If we see value and we are able to change, we need to change, we will definitely change there. Then there are businesses which did well for a length of time, then they've not done so well. And we have avoided because we think they're brittle economics, and we remain perfectly comfortable about that decision. And then there are businesses that we have bought, which have done wonderfully well in this period also, and continue to strengthen our conviction on the philosophy that those must be retained. Some of them have been we have been holding for a long period of time. Some relatively of a recent origin, last 3 years, 4 years, 5 years. But all of them which do well, and not only in the past but now, is a source of booster. So let me assure all of you, while 2022 is a chastening period, is a deflator period for us. Our portfolios have done relatively poorly compared to indices on an absolute basis also. The performance of the portfolio is not at a place where we would like to see or where we normally are. But at the same time, we are agile, we are watching, we are not slipping on the wheels, is something that I can assure you. And I definitely believe that going forward, our long-term compounding engine has to deliver both on the absolute as well as on a relative basis, including for the period where we have not done so well, which is including 2022. The period ahead will cover the ground. We remain deeply committed to it. We remain deeply observant of ensuring. And your money is an article of faith. For me, more than anything else, it is the passion of investing. It is gratitude of serving the wealth of the people who trust us with their money. Because it is very difficult for people to trust somebody else with money. Even spouses take time to trust their money with the other spouse. Therefore, your money is an article of faith, and delivering healthy outcomes, acceptable outcomes over a period of time is not only an onerous burden, but I regard it as an article of faith, article of trust, and indeed an article of honor for me. And we remain deeply committed not only to discharge that, but to deliver the kind of gratifying results on a long term that we have been known for and have remained deeply committed to. With this, I'll close here and will be too glad to answer questions.
Thank you, Bharat for a very, very detailed explanation on equity markets and also on our philosophy and portfolios. Friends, as we said, there were two parts of the presentation, but Bharat, as passionate he is, we had planned about hour and 10 minutes for that session, but the way he's covered a good length of the questions out there. For the next 45 minutes to an hour, as much time, we have read all our questions and we will curate, me and my colleagues will curate to Bharat, and we'll try and ask as many questions as we can cover within the time frame we have. So thank you, Bharat. We wanted to have a water because I think you were continuously talking for almost an hour and 25 minutes. So it's not easy. Please do that. I will just go because you covered on the performance. I think everybody was eagerly waiting as to what in CY22, why has been the performance not up to the mark. You covered the reasons, the discipline, the wisdom will do it. But if I can just take that question forward, what everybody is anxious is about that they believe they've lost the returns of the last 1-2 years, which have made now. So the question is there, should they, I'm just asking exactly crude question that they ask. Should they exit now? How long will it take for the performance to catch up? Because most people want to know how will the catch up happen. You talked about Metropolis, the reasons. You talked about Bajaj Finance. You talked about all the stocks. When do you think the performance of this portfolio is to come back? Over to you, sir.
Honest answer, I do not know. And I do not want to promise anything loosely or merely to please people. Markets don't easily lend themselves to the comfort that, like a predictable formula, things start falling in place and do all that is required. For all you know, it may be just a matter of month. It may take 3 months. It may take 6 months. It may take a year. I wish I knew, but I don't. And it will be dishonest on my part to give some artificial time frame as if a magic wand would occur. What we have to do and what we are deeply committed to is to examine ground zero every name, every entire portfolio, and not only what we have, but what we don't have and which has worked well, and trying to see whether there is any need for change. Some changes we have already brought about in the portfolio, and it will take some time, hopefully early rather than late, but hopefully for it to start showing the effect. Some other changes, if we recognize, we are able to comprehend, we understand, then we will bring it about. All I can assure you is if there is a mistake, we do not stand on ego. We will weed it out. We will ruthlessly deal with it. Equally, when there is a good thing and temporarily it is out of favor, we don't want to throw it away because that's a classic mistake to make, especially when you are not doing as well, then you are under pressure. And that pressure makes you do further errors, which are unfortunate and creates next round of errors. These forced and unenforced errors is something that we remain very cognizant of. Therefore, good things we don't want to throw it out. Bad things we don't want to go and embrace. Good things we did not have, but we needed to have. Whatever we have understood so far, and keeping in character of the portfolio and overall blend, we have made some changes. There are some more changes which may happen, and we are deeply and closely analyzing, and some of them will happen at some stage of time. There are two types of errors of omission and errors of commission. Both errors kind of cause a grief, but errors of commission are far more risky and dangerous. Error of omission occurs when you miss out something which is good and healthy and which has produced right results, but you do not have. When there is an error of omission, where something is done well, you have to ask two questions. Whether it was a healthy outcome that occurred, in other words, whether it deserved to go up that much, and the next question is whether it is sustainable thereafter. Many of the businesses may go up at a point of time, but if they are not long-term worthy businesses, then you may produce a mirage by chasing them. Because, for example, if PSU banks on a 15-year basis have produced negative returns and something goes up 2 times and 3 times in a 1 calendar year, it does require very careful analysis rather than getting carried away. Therefore, in hindsight, whether we would have bought some of these businesses, probably not. And therefore, error of omission of a kind where even in hindsight we may not have got into, doesn't really bother us so much. But errors of omission of a business that we should have got and was within the circumference and our circle of within our circle of competence, we should have got them. Some of those misses definitely hurt, and we are carefully watching. Some we have built into the portfolio, and where the overall portfolio balance and character permits. Some others we may find and we may build into them. But errors of commission, when you buy inferior thing, just because it may be very popular, can be very, very deeply grievous and deeply hurtful. Errors of omission gives you heartburns, but errors of commission can give you heart attack because it will actually destroy the value of the portfolio. And we will not like to make errors of commission. When we buy inferior businesses in the anxiety to catch up on a performance, when you buy bad managements just because it may seemingly be working well at a point of time, when you buy into inferior value proposition, even though it may be popular to be chased at a point of time, all of these can end up as significant errors of commission. We would like to avoid errors of commission. Errors of omission, some will occur over a period of time because there is only space for 20, 25 names in a portfolio. And if there are more than that, which have done well and are expected to do well on a long-term basis, then some amount of errors of omission will occur, but we are conscious and mindful of it, and judiciously what needs to be built, we are building. I wish I can give you some definitive pleasing time frame in which it will be Cinderella moment and everything will look hunky-dory. I wish I knew, but I do not. And it will be dishonest on my part to give some artificial timeline. But if the processes are right, our energy is right, our intent is right, our discovery mechanism, which has stood us in good state for 20 years, is right. Ultimately, good process has to lead to good result. There are times when markets will insult you, humiliate you. 2022 is a humiliating year for us, a humbling year for us. With my hands folded, I bow before Mr. Market. I never have any ego in dealing with that ever, neither in the past, hopefully never in the future. And therefore, we take with a deep sense of reverence what markets have handed out in 2022. But every day is a new opportunity, and overall, we remain deeply convinced that broadly, the names that we have, overall portfolio character that we have built, the overall synergy and the strength of the portfolio as it stands, all give a good confidence and belief that our long-term results, what we have to, what we are known to, and what we must do is something at some stage will come into the offing. I hope sooner, but I can't predict.
Thank you, Bharat Bhai, for the honest answer. If I read the questions posed by, there are some of the judgments they have made possibly could be the reasons for the underperformance in CY22. While we have addressed in the past, we request you to share, and I'll take down the three questions which put overall. First is the change of management, which has happened in this calendar year, where people are believing that Blackstone taking a major stake in the organization, will that change the way the ASK's style of investments or philosophy of investments, which they have believed, and they're just making that assumption, is that is one of the reasons that it could possibly happen. Second, connected, so I'll ask the third part later, is the exit of our Pratik in the recent times, and has that led to who's going to replace it there? Is there something changed again with regards to philosophy or style of investing at ASK? I leave it to you for answering both the questions.
Sure. The first one is both are straightforward and simple to answer. First one, Blackstone. We deeply respect Blackstone reposing faith, a global giant, having majority stake in the firm, is a humbling token of respect accorded to us and belief about our not only what we have done in the past, but what we are in their estimation likely to do in the future. And therefore, investment by Blackstone is a deep act of faith and article of trust. I have two levels of article of faith to be discharged. One I mentioned earlier to my clients, to whom I owe the first and the foremost, because my clients are the ones who repose faith, who give the money, and discharging their faith and discharging their trust in a long-term way, in a right way, not only getting the right results, but also with a right method. Both remain very, very important to us. And more than anything else, what drives my interest is my passion for investing and my deep commitment to my clients to discharge that article of faith, to deliver healthy, process-driven, and not only good results, but honest results over the period of time is a very important personal commitment. And that is the first faith I have to discharge. Secondly, when even though I'm a shareholder of the firm, but Blackstone clearly is the majority and big daddy shareholder of the firm. But they've written out this large check is a commitment and faith in us, and discharging that faith and building value for my majority shareholder is my abundant duty. And that will happen when the client portfolios are built well with discipline and integrity and delivers the right results. Automatically the value of the firm will rise in the process, and therefore I'll serve the interest of Blackstone. And therefore, both these interests are together. And actually, there is a third duty that I must mention to my people who are in the task of managing money. I owe it to them. They are partners in the journey, and upholding their strength, upholding and growing their capability, growing their knowledge, and preparing them for their capability to contribute to the client outcomes is again my duty. There are three articles of faith that drive my motivation: to serve my clients and their money, to serve my people who are in the same journey to build wealth and value for the clients, and to discharge the faith of my majority shareholder. Let me assure you, Blackstone has not done anything whatsoever whereby they've tried to cramp our style or our approach or attitude or anything. If 2022 has been less than gratifying, it is entirely due to me and us. It has nothing at all to do with Blackstone. So please do not, it will be unfortunate to blame Blackstone shareholding for that in any way. They've been actually a great shareholder, very supportive, and very understanding of how things are done in investments. So absolutely no impact whatsoever of any adverse variety due to Blackstone. In fact, it has given us some kind of greater recognition in a more public way when a giant like Blackstone, known to be a very agile player globally, to have kept a faith in us. Pratik was with us for almost about 11 years. It was the 12th year when he left. Pratik has been a good resource. Personally, I definitely would miss him, and I would continue to miss him. Every good individual who has been with the firm at every point of time, not just at ASK, but the ones at Birla Mutual Fund, many of the people who have gone on to occupy some very significant responsibility in different organizations, in different journeys. I remain deeply proud of everyone. Therefore, every good resource, every good individual, I remain personally committed to. And therefore, all good individuals are missed, Pratik included. But we have always built our strength of the team. Investment team in particular remains deep commitment in terms of capability and strength that is to be built. Sumit Jain, who now heads the investment as the CIO, is an outstanding investment professional. Sumit has been with us for 15 years. I do not know of too many investment professionals and too many investment people with the sense of panache, intensity, analytical capability, and philosophical depth and purity that Sumit brings on the table. So I remain deeply proud of Sumit as the leader of the team. We have, in fact, three senior individuals we have inducted into the team over last 2 years. And we are creating further deepening of the leadership team there in the investment team. In fact, the two more leadership positions we are looking at hiring and adding to the team, what is already a very large investment team. So we continue to invest into the talent pool. Apart from the three that we've inducted over last 2 years, we are in the process of inducting two more in some time, apart from other already existing resources. So work goes on, commitment goes on, our intensity, our passion goes on, and that's what drives us. The day you see that passion going away, that is the day you should divorce from us. Till the time you see that passion and commitment, that's what drives us. And I personally get driven by that. Uh, Good investing will make you rich, and good investing will make you wealthy. So that's a given outcome. Good investing gives you recognition, and many of you are on the call. Is a deep article of trust, which I deeply respect. But more than that, money or wealth or recognition, what drives me is an opportunity to, achieve, discharge the faith of the clients, discharge the faith of the other people who have trusted people in the team, stakeholder like Blackstone, plus the chance to have learning opportunity that investing provides. It is so enriching journey, and getting not just the right results, but with the right process. This is what drives us. So long as you see that, you should have, in my opinion, no reason to feel worried. And let me tell you, a very significant amount in 3-digit number of my own personal capital, 3-digit crore amount of my personal capital is into ASK different portfolios. And I keep adding more, and I'll keep adding furthermore to that all the time.
I remember, Bharat, you and your family invested a large chunk of money in the last 2 years' time, and I was party to doing the documentation, so I can't agree more. And thank you for introducing Sumit to everybody. And as I said, dear investors, this is just the beginning of our interaction with each one of you. Today we started with Bharat. In 2023, I promised that you'll hear more from Sumit Jain directly. Maybe in the first quarter of 2023, we'll have Sumit, who has been a silent performer in the ASK for the last 15 years. We will get to hear more. But by the third part, which I'll come to again on the performance part, they believe, again, the perception is there that ASK size has become a reason for, not being able to generate alpha. And since you did 37,000 crores of asset at the start of the year, IEP being one of the largest strategy, that's one of the reasons that it's led to underperformance. Over to you, Bharat.
Simple answer. No, a categorical no. At 40,000 crore, if we think the size is limiting, then we don't deserve to be in this activity. Even at 1 lakh crore, at 2 lakh crore, if that comes out as a reason, anytime I'll be embarrassed. If we can't manage, returns will be constrained not by our size but by our capability. At 40,000, we are a drop in the ocean. This market is 285 trillion rupee market. What are we at 40,000 crores? It's just a drop in the ocean. Even at 1 trillion rupee, 1 lakh crore will be drop in the ocean. At 2 lakh crore also will be drop in ocean. If that at any time you hear from us as a reason, then you should be ashamed of us. And I'll not give you that reason for you to feel ashamed about. Size is not a constraint. There is a huge opportunity, and it is for us to seize that opportunity. I'll give you some more factual data. You, you take out last 3 calendar years, 2019, 2020, and 2021. 2022, already I mentioned that we have been underperforming, and it affects the previous period numbers also when you take it point to point.
Yes.
But if you see here in isolation, 2019, 2020 calendar year and 2021, every single strategy of ASK on that 3-year basis has delivered an alpha compounded of 2.5 to 5% compounded even in that 3-year period. So you take 1 year before pandemic, 2019, pandemic year 2020, second round of pandemic 2021, in that cumulative year period of 3 years of 2019, 20, 21, every single strategy, not a single strategy of ASK has underperformed. In fact, every strategy has delivered compounded 3-year alpha between 2.5 to 5%. Now, the 2022, of course, has been an impact, and it takes away some amount of shine of the previous periods as well. But really speaking, much like investing has to be analyzed over long run rather than short run, truly investing has to be viewed a period in isolation rather than a particular period where sufferance has occurred and combine it with immediate previous period. That will produce a potentially misleading analysis. I'm not trying to offer it as a reason or a defense. I'm clinically, just scientifically analyzing why it is important to analyze year by year some period. And for the sake of simplicity, 1 year is a reasonable unit to analyze. In the year of 2019, 20, and 21, we still were very large player. Our asset size had not been low or anything at all. And our assets have continued to grow in that period, and they will continue to grow from here. Please be assured and please be clear. We will never offer asset size as a reason for our less performance or underperformance. It will be a matter of embarrassment for me if I ever have to say that. Secondly, market in India, economy of the country offers gigantic opportunities. 40,000 crores that we manage is just a drop in the ocean. It's nothing. I'll think about something when we maybe 3 lakh crore and 4 lakh and 5 lakh crore, maybe we'll see where we stand. But today it is very premature and completely Whatever it is based on us. It has nothing to do with the market opportunity. Market save opportunity. Our capability, if it is low, then only results will be affected, not otherwise.
Sure. Thank you, Bharat. I'm now consolidating questions. A lot of them are asking, like in the last 1-2 years, we have put money based on a good performance IEP. We put money in emerging opportunities portfolio, which is your mid-cap kind of strategy. What are your thoughts there? Similarly, for Golden Decade Fund, I know it's a multiple strategies, but I'm just consolidating for all the investors to know that I'm trying to ask them together. Other than IP, how are your other portfolios poised to perform? You gave a lot of confidence, and in particularly since we entered into EOP, Golden Decade funds, and so on and so forth, which are down again in this year. So your thoughts there, sir?
No, no different answer than what I have given so far for the previous question. All our strategies are governed by the same philosophical purity, same filtering criteria, same strategic approach, and same long-term mindset. Each strategy may have a particular nuance, but philosophical purity, stock picking methodology, the purity of all of that is not in any way a different, challenge, compromise ever in any of the strategies. I talked about 2019, 20, 21 performance. You look at the year of 2019, emerging opportunity portfolio, if you look at, that was the year when markets lost 2% in the benchmark index. But that portfolio was up 19% in that year, in the year of 2019. So in a year when the benchmark index had dropped 2%, that portfolio was up 19%. So with a difference of over 20% in a single year. So no portfolio, every portfolio is our own baby, loved babies, and fully nurtured and cared for babies. Indian entrepreneurial portfolio may be the largest, but the care and attention is the same. Philosophical purity, stock picking approach is the same. Nuances or the backdrop of the strategy may be different, like in the emerging opportunity, accent is more on businesses where the greater proof of concept will be likely to be in future than today, compared to let's say Indian entrepreneurial portfolio, where strongly established businesses and yet continuing to deliver are there. But barring that little difference in the background, philosophy and approach remains consistent. In the Golden Decade also, the effort is to find which are the businesses which will benefit even more from the coming great upturn for the businesses and the economy in the decade and two ahead. So many of the businesses like specialty chemical, businesses of manufacturing which are benefiting from PLI scheme, businesses from insurance which are benefiting from tailwinds of the growth. Then the businesses of, for example, cement, which will benefit from strong infra thrust that the government is putting and the robust demand on the real estate side, or premiumization, where consumers are moving from mundane to premium items, or business industries which are moving from less organized or less structured to more organized and more transparent picture. Those are the kind of businesses which are emphasized. But the philosophy for picking a stock building the portfolio character and risk control and overall approach remains the same. So all those portfolios have to deliver absolute, healthy, long-term compounding, and be in appropriate superiority over the benchmark and the indices. Both we remain committed to over a period of time.
So since Bharat, I'm representing today the client, I'm saw 4-5 questions again. You already answered that, but some of them are slightly losing patience, or not patience, but what they're saying is their India Select portfolio. If you can just give your candid thoughts about that as well. The ones which are slightly shorter period of time, we would want to see the 5-year period of time. But if you can just a little bit more throw light on the India Select portfolio, how it can come back, and what's the thought there?
Well, even India Select portfolio, first of all, let me say India Select portfolio has done less well than what we have desired, and what it has done prior to that all along, and what we must deliver. So the relatively recent period performance has been shorter than our expectation, shorter than our capability, shorter than the past track record of that portfolio, without any question. Secondly, even India Select portfolio, in the period of 2019 calendar, 20 calendar, 21 calendar, 3 years put together, it is at a relatively lowest alpha, but an alpha. 2.5% compounded alpha, even India Select has delivered in when you combine the period of 19, 20, and 21. What has hurt relatively more India, but India Select has performed less well than its own past history, and it has done less well than the other ASK strategies. And therefore, it becomes a bit more visible issue without any question. Fourthly, there have been some mistakes we made in India Select, without any question. When the pandemic time came, there, in fact, basically 2 errors have hurt us immensely. One, we had a name like Kajaria Ceramics, and second, a name like AU Finance Bank. Both were sold away. Chola Finance. These businesses we sold during the pandemic time, and what we got into, what we thought were relatively more safer looking businesses like Hindustan Lever or like Nestle, etc. At that point of time, we got into what we thought were looking relatively more safe, and we moved out of the businesses what we thought look less certain. Like Kajaria Ceramics, our feeling was that when whole world is shut, there is a lockdown, businesses cannot even, you can't even go out. Who is likely to bother about putting tiles in the home and sanitary ware in the home? The logic is right. Yeah, that is the way it actually happened also. Therefore, business suffered tremendously. But you see, when things started normalizing, the price catapulted at a huge way. With the same logic that who will really put tiles in the home during pandemic time, the stock price collapsed sharply in that period. And after that fall, we made a second error of selling it, rather the first error of selling it at that price. And therefore, what was a notional drop, it got converted into a realized drop. Similarly for AU Bank, similarly for Chola Finance. The same logic, AU Finance is mostly into SME and into the automobile related vertical, and that will be affected the worst. Chola affected by commercial vehicle because that is the largest lending segment, and automobile as the key overall segment affected more, then they all fell sharply during that period. Unfortunately, when we acted and by the time we could finish selling, we locked into materially lower price at which we could exit. The businesses that we bought look more defensive, more certain that you still need food and you still need your personal care and other products. And that logic also sounded tempting, but eventually proved to be not very helpful, because those businesses did not fall so much during the pandemic time. From the time when we got, they have gone up, but they've gone up by 30%, 40%, while the businesses that we sold have gone up by 200% and 300%. And therefore, just this selling of 2-3 names and buying into more defensive names, against that is entire underperformance and more of India Select in this period, actually. That is the clinical exact analysis I can give you. But for that, India Select portfolio also is a robust. Today, all the changes that we believe we need to do are there. Some more small tentative changes are there in the process of being effected, but overall portfolio, I believe, is in a very strong shape. And therefore, the period ahead will show its strength, and it will retrace some of the past as
well. Again, thank you, Bharat Bhai. And investors, as I promised at the start, what we will also do is that Chetan, Sandeep Bansal, Kuldeep, all of our great portfolio managers will interact with you in the coming quarter, and they will take in a little deep dive into each of your portfolios. So allow us in terms of the January of and February of 2023 to come back to you and address a lot of questions. But we're going to take a lot of questions again here. But the next thing, which again I'm consolidating a lot of questions are there. Some of the stocks in your portfolios are down 30 to 40%. So the question they're trying to ask, what is the exit strategy? Why are they in terms of in the portfolio? They tend to worry that, they felt we could have sold the stock in our easily and re-entered kind of thing, or at least share us your exit strategy of the portfolio stocks, please.
Let me first give a little philosophical answer and then a more precise answer. We sometime back did a study of the top 50 businesses in the market at that point of time who have done well over the previous 15 years. That means these are the businesses at that point of time who on the previous 15 years put together have produced the highest returns. So we put the returns of all the businesses in the market over the last 15 years and then picked up the top 50 names out of that. So these are the businesses which have done well over last 15 years, the highest in the market. Therefore, clearly, these are the businesses with a survivorship bias and which have already delivered. But when we analyze that further, each of the 50 names which have done the best in the market of 6,000 names over that 15-year period, each name on the 15-year basis, on a year-to-year, the difference between the high and the low of that year varies from 20% all the way to 65%. I mean, even names like every single name that you can conceive, like a name like Bajaj Finance, which is compounded at the rate of 61% over a 15-year period at the time when we carried out that study a few months back. Despite that, every single year, minimum volatility, even in a name like Bajaj Finance, which has delivered through that 15-year period 61% compounded return, year to year gap between high and low has ranged from 20% all the way to 65%. That means in a particular year, if the Bajaj Finance price high is 100, the low may be as low as 35 rupees in that year. And every single year, not over a 15-year period, every single year, minimum 20 to 65. What does it tell you? That volatility and violence are recurrent twins of the market. Markets are never divorced from volatility. Markets are never divorced from violence also time to time. Even good businesses are not immune to that volatility or immune to the violence. All that the good businesses can do is through the period of volatility and violence, over a period of time, going through that ups and down gravy train, still net they will go up, and bad businesses through ups and down and the volatility net over a period of time, they will diminish. Therefore, good businesses are not immune to the volatility and violence. Oh, they are immune only from long-term damage that bad businesses suffer from. And they have antidote of ensuring high quality long-term returns, even though they suffer time to time humiliation of the fall. Therefore, good businesses, the top 50 businesses which have done the best in the last 15 years, still have gone through high-low every year, not 1 year or 3 year or 5 year, every single year, minimum of 20% all the way to 65%. That should tell you that our focus should not be on how far it has gone up or gone down, but whether business is continuing to be valuable or not, whether it is doing the right things or not, whether temporarily sometimes markets may detest or dislike even good businesses. And time to time, markets may embrace even the ones which have been very unpopular or very shunned, or bad businesses also. Both things can happen. Time to time, markets may take love for discarded businesses or bad businesses. And time to time, markets may ignore good businesses or the ones which have gone through huge amount of popularity. But key test remains whether the business is doing right thing, whether it is valuable today, looking at tomorrow, and whether the price vis-a-vis value continues to offer you margin of safety and overall good double-digit or healthy returns that you target over a long run. So long as that test is intake and so long as that answer is given objectively rather than emotionally, it will work well. Even then, time to time, some mistakes may occur that we may realize a little late that something has been affected, something has impacted on a not short term but rather longer term, and therefore our action should have taken place earlier. Some of these mistakes may occur. Some mistakes of this kind indeed have occurred. In retrospect, when I think about it, a name like Metropolis should have been, we could have either materially or entirely could have unlocked the gains because it had been little too fast and little too ahead of the time and little too presumptuously. So it was a mistake that we were little late on that in recognizing. But the fact that something has fallen or has fallen materially is not an automatic logic for doing anything, because that is something invariably occurs, as I explained to you when you examine the history. For every business, that's a reality.
Thank you, Bharat. Again, just building on that same question further, they believe that philosophically, two stocks, which again they have said, how did they come into your portfolio? One, they claim, how did Patanjali? At least I saw 7, 8 questions that how did Patanjali came in the schema of this one? And again, Metropolis, though you covered there. And then there'll be other 1 or 2 stock questions which we'll cover there. But if you can take up on Patanjali and a bit on Metropolis, how did it come in our filtration criteria? It was on philosophy.
Metropolis price has fallen, but it is not as if business is doing poorly or inferior. Price certainly is affected, but whether it is activity which is not required, certainly not. You do need diagnostics. Do you need a quality care and quality diagnosis rather than some unknown or badly run pathological lab? Of course, you need a quality diagnostics. Whether Metropolis operates its diagnostics at a standard in scale and character, in my opinion, in terms of the sheer range of tests that Metropolis does, and some of the specialized tests only Metropolis is able to do in the country. There are some tests which are unique only to Metropolis, very, very high-end kind of tests. So Metropolis is a very high quality, very conscious and conscientious kind of laboratory diagnostic chain. The business through COVID, it jumped up because of the COVID volumes. Once the COVID has been abating and virtually gone, those COVID volumes have fallen apart. And therefore, obviously, when you compare the results now compared to that period, results will look lower. But the core business has continued to hold on. Secondly, in the same period, heightened competition out of kind of free money kind of situation of Farm Easy and some others have come by. Many of these are not very long-term sustainable kind of situations, because no Farm Easy seller of the medicine doesn't automatically become diagnostic chain without running detailed quality care, and even after the acquisition of diagnostic chain that they've done, it doesn't automatically guarantee. Because diagnostic chains are driven by the reputation and the image in the eyes of the customer, which lab they will go to. For critical tests, would you go to somebody whose diagnostic report you may not have faith in or trust? These are important issues. Therefore, quality diagnostic chains enjoy a premium because they have faith of the customers, they have belief of the, and one of the most important customers is a doctor, because doctor knows much better than an average patient with diagnostic chains can be trusted or otherwise. And that's an industry where per se diagnostic need as an industry, in my opinion, should grow at a rate of 11-12% on a compounded basis on a long term. Because the COVID also has reminded people the care and concern for the health has become important. Investment by government in that area also has become going to be larger and long running, and therefore these will mean long term running growth for that activity. Apart from that, even today, close to 70% of the total diagnostic activity is run by very inferior kind of pathological single location lab. Very inferior one. In a sense, you and I will not even dare to step into those kind of laboratory for any checking to be done. You are more afraid that you may catch some disease by going to those diagnostic chains for that pathology lab, not chain, to get yourself tested. 70% of that industry is still unorganized and inferior quality laboratory. Tens of thousands of such laboratories are there traditionally. Eventually, share of all of them will go away. And like in everything else, they will convert into the hands of the better quality and stronger labs with reputation and brand image and quality. Therefore, all of these are long-term secular trends for metropolis in favor. Their core business, their capability all remains intact, but price has been such a dramatic drop. And prices dropped for three reasons. One, it went up way too much than it deserved. And therefore, on reflex action, the drop is also sharper. Second, heightened competition from new players like PharmEasy and Tata One MG, where suddenly test cost is dropped to like small pizza cost and all that, has really unsettled the equation in the industry and created confusion. Third, the COVID volume business was large, and that suddenly vanishing makes the numbers look weak in comparison compared to last. All this put together has created a sudden impact of the price. The lake has been with a large stone throwing recurrently has been, lot of ripples have been created and therefore price is impacted. But business is sound, management is high quality, brand is hugely reputed, and I would say one of the finest in the country. And therefore, what we have suffered is on this account, despite that being a very fine chain. Patanjali, let me give a little bit of history. Earlier, there was a company called Ruchi Soya. Ruchi Soya was badly run and badly managed and, run by management, which not only was mindless about risk undertaken, but also leaked the balance sheet and mismanaged the finances of the firm. Therefore, it went into bad time. It runs a very popular brand in the edible oil with the second largest market share in the country. Edible oil, still Ruchi, various oils that they sell in the edible side are among the very category leaders in various parts of the country. The second part, their healthy food, the Nutrela platform, the Golden Nuggets, these are huge brands in their respective areas. In some of the area, for example, in southern territory, southern country, part of the country, those Golden Nuggets brand is 70% market share. So these are very strong businesses built, but was run in a very speculative way, and indeed finances were mismanaged. And therefore, Ruchi Soya went through tough time. That firm also speculated on oil seeds, which was not their business, and therefore they came into bad time. Then they leveraged, and with the leveraging and with the downturn of the business, they went into a further downward spiral. 3 years back, exactly 3 years back, actually December 19, 2019, 3 years back, Patanjali stepped in and bought over in NCLT Ruchi Soya. Since then, Ruchi Soya, which has now become Patanjali Foods, therefore, what was the Ruchi Soya liability, all have been eliminated. It is a debt-free balance sheet with a lot of cash on hand. Secondly, apart from oil business and the health business of Ruchi Soya, Patanjali Foods has now two more businesses. And the two businesses have been imparted from Patanjali's stable. So first business came last year in 2021. That was a business of biscuits, noodles, and breakfast cereals. The business turnover at the time of shift from Patanjali, which of Patanjali is held 100% by the private individuals. And Ruchi was a listed entity that time too. These 850 crore brand business with operating profits of about 155 crores was shifted, rather gifted to Ruchi Soya, which has now become Patanjali Foods, at a mere price of 130 crores. So it was like at less than 1 year of operating profit, it was gifted away. And in the biscuits, the biscuits are fantastic, very, very reputed products. Some of the biscuits, personally, I've been a consumer. Some of the products are actually the best in the industry products. If once you enjoy those biscuits, for example, Doodh biscuit, and these are without any menda, these are all atta biscuits, and yet very tasty and very good biscuits. So that was one. In the year of 2022, they shifted even a bigger food business of 5,200 crore with an operating profit of 860 odd crores at again like a gift at a price of 625 crores, less than 1 year's operating profit. Now, what are the products shifted? Ghee, which is Patanjali ghee, is a market leader today with a 1,400 crore turnover, and it sells at a premium in the market at 10 to 20% compared to other ghee, other various brands of the ghee sold in the market, including Amul and everything else. It also had edible oil portfolio of almost about 850 crore. Then it has shifted a juice portfolio, health juice portfolio. So amla juice, giloy juice, aloe vera juice, all these are category leaders, profitable, fast growing. I personally am consuming some 30 odd products of Patanjali group for last 7, 8, 10 years. And I'm personally aware of why these products without chemicals and without artificial ingredients, why these are superior and good products to have. These in terms of, therefore, it has built a very large, successful new vertical, third vertical food portfolio. 850 crore first portfolio, 5,200 crore second portfolio, and two together are growing at a rate of 15 to 20%. Fourth vertical, fourth area that they've introduced about a year and 3 months back, very high growing portfolio, very profitable portfolio, nutraceuticals. Therefore, that is the fourth portfolio. Nutraceutical is a 55,000 crore market, growing at the rate of about 20%. In 5 years' time, that should become more than 120,000 crore kind of a market, and easily Patanjali should be able to get at least a couple of percentage, 3% of that market, a business worth about 2.5, 3,000 crore over 5-6 years, and very profitable activity. So today it is 4 businesses. Edible oil. So Ruchi Soya had 2 businesses. Patanjali Food now has 4 businesses. Edible oil, which is a low margin, low growth business. Margins are about 4.5-5%, but a decent return on capital employed, about 20-21%, because it doesn't have much working capital. Even capital fixed asset intensity is relatively not that high, but it's a low margin activity with about 21-22% return on capital employed. Growth rate for quality players like Adani Wilmar and Patanjali is more like 7-9%. Industry is growing at the rate of 4-5%. The margins are low, about 4.5-5, but with an upward bias as the size becomes greater. 20-30 basis point rise in the margin year after year. But current year, it has been very violent, where edible oil prices have gone through dramatic ups and downs. Therefore, it has been very unusual, where raw material prices have gone down by 80-90% in a business with 4.5% margin. How do you handle that volatility? And yet, therefore, everybody has suffered in this period. But long term, this is the picture. Food portfolio is about 15% odd margin, and I would say growth rate of about, in the hands of Patanjali, closer to 15 odd percent. The health business that already existed in Ruchi and which is now being grown is again growing at a rate of about 12%. Margins are in the range of about 15-16%. The nutraceutical portfolio, newly built, is growing at the rate of about 20-25%, and the margins are in the range of closer to 28-35%, depending upon products and the category. This is the overall portfolio that Patanjali has built. From the price at which we bought, when at the FPO level and then subsequently in the market at a higher price, the economics of the business and the valuation has been among the most compelling ones. Return on capital employed is affected by edible oil business, which is a relatively lower ROC, but the rest of the portfolio is a high ROC business. Over a period of time, that business will become greater and greater ROC businesses. Relatively, the edible oil business will be lower part of the profit. It is, and it will become much higher in favor of the other 3 businesses. Therefore, fundamentally, 3 large long-term trend: health, wellness, and Ayurveda. All the 3 trends are real, very strong and secular, and Patanjali Food is right at the cusp of enjoying benefit on all the 3. Then the management behind that. Swami Ramdev and to some extent Acharya Balakrishna, both may have their own very public image, and especially Swami Ramdev, who is a very outspoken, plain-speaking individual, and therefore in a kind of social milieu, there can be lot of so to say, views and opinions about the individual in terms of his opinions and expressions that he makes. But in terms of the sheer capability, sheer integrity, and sheer dedication, and I've met these individuals now over a dozen times, and keep exchanging into dialogue with them. These are, I would say, our people are rare to find with unimpeachable integrity, huge commitment to the society and to the cause of the people. And they may have their own strong views on some matters concerning society as citizens of the country, but their own capability in the business, commercial sense of Swami Ramdev is unbelievable. I mean, that man, he has such sharp capability to pick up ideas is something to appreciate. Therefore, integrity, commitment, fire in the belly, and the commercial sense, yet offering reasonably priced products in the country to the people, and yet making healthy profits for themselves. Think of it this way. Dabur in 130 years is about 10,000 crore domestic business. Patanjali business with the comparable products of Dabur is 17,000 crore business in 13 years time. So it requires some doing. They today, overall Patanjali group is about 1,000 SKUs. Of course, Patanjali food is separate. There are other Patanjali Ayurveda medicine, which is 100% Patanjali private today. The Patanjali food itself is about 350 SKUs of different products. And I'm a personal consumer of some 30 odd products over 7 to 10 years. So I have some idea about the products and what they stand for. So we believe from a valuation, from the future, from the management quality, and the sheer size of opportunity, in all respect, that is an investment that makes a lot of compelling sense to us. Of course, there are many areas that they need to improve upon. Their distribution system needs to be revamped. Now, digitization has happened quite nicely in their activity, where they are able to, on a real-time basis, they get a lot of data digitally. But the distribution area needs to be streamlined. They offer less commission to the distributors than traditional consumer firms do. Therefore, they have a little more challenge because their products are all priced much more competitively compared to the brands. While I would say many of the products are actually far superior to the competing brands. Therefore, they need to improve on their distribution, but their product, their innovation rate, the speed with which they come up with the new products and very high quality products, I would give them a huge credit for that. There are some other areas in terms of strengthening the organization, getting more talent pool. They already, last 3 months, they've added 2 very senior people from the industry. Their CEO comes from Kargil, who work for Kargil, who work for ITC Food, and who work for Reliance Food. That is the CEO who runs that activity. But they hired 2 very senior leaders in 2 verticals of the business in last 3 months, and they are in process of beefing up there. So there are the issues that they need to sort out, but overall, I believe it represents a very compelling opportunity.
The investors, the answers on both Metropolis and Patanjali will give an indication of the depth of study Bharat Bhai and ASK team does. Okay, and we again experience when Bharat Bhai speaks with passion, we just don't understand time, how passes by. I get present that he's been talking for almost 2.5 hours, and therefore I would like to, consolidate the 3 feedbacks from the client and close this webinar. The first, Bharat Bhai, the clients have said, maybe in the question and answer, they've learned a lot. So maybe we can spend some more time next time around where you can, talk a little macro, a little less, and we can speak 70% of the time on the question and answer. So feedback taken from the client. I think they learned a lot from the Q&A. So we'll do that. Second, about when Bharat was speaking, I read a lot of questions, and most questions were best answered by the portfolio manager. And as we said at the start, in the coming year in 2023, we'll have the portfolio managers interact directly with you like we're doing today. So hopefully a lot of questions which have not been answered now, specifically the portfolio. Some have mentioned there, there's a cash balance in the portfolio, some stocks widely invested, all will be addressed by the portfolio manager. And I promise that we will do that in the first quarter of 2023. Third, you would have observed that we've gone ahead and asked tough and straight questions to Bharat Bhai, and he answered them all with as much honesty. And he has not ducked any questions, neither we have tried to duck any questions asking him. But I understand that 2.5 hours is a lot of time on a Saturday. We thank Bharat Bhai for his time, but we also what we've done that a lot of people exited in the middle and they've requested to send us the recording. We promise to you once the recording are ready, we will email it across to you and you may hear it again. I think this has been a great Saturday. On behalf of the clients, on behalf of the ASK team, I really thank Bharat Bhai for giving his 2.5 hours of time and answering it as passionately. As I said, you would have heard him about 10 years back. I think the passion has only gone higher. So we thank you, Bharat Bhai, for your time. And we will reach out to you if there are any further questions raised by clients and investors. Thank you so much. Bharat Bhai, you're mute, Bharat Bhai. We're missing you.
Yeah, sorry. I'm happy to answer some more if there is if there are any questions which have not been addressed adequately.
I think what we've seen, it depends. I mean, very glad. What do you think, Nagesh, Ajay, Vishal? We've seen some 500 plus participants reduced to about 200 odd. You've given us a time on Wednesday again from 4 to 6. What we will do then is we consolidate all these questions and send it across to you. And as recommended by a few investors, we'll start with Q&A so that we can utilize that 2 hours time. And we are sending the recording back, so we can cover all the questions if there are. Okay.
Yeah, sure. But no need to send me questions. I can answer the impromptu when you raise them. No need to send me questions.
Again, the investor understand there's nothing which we and Bharat Bhai is always candid, happy. He loves actually interacting with investors. Unfortunately, due to noise, which people could be at different stages of in the house, somebody on the road, we had to keep it a one-way webinar where it's easier to converse. But trust me, we will take those questions again on Wednesday without telling him, and we will take it with the portfolio manager in the coming quarter. With that, Bharat Bhai, we really thank you for your time on a Saturday morning. Thank you, investors, for joining in.
Thank you, everybody, and delighted to be amongst you. And please be sure your money is an article of faith. And there are very few things which motivate me. Investing is one of them. Discharging duty to my clients and to my team members is another. To my shareholder who has kept faith in us is another. And the knowledge acquisition and the sheer battle that you have to fight in the marketplace, that excites me rather than makes me worried. I enjoy these battles rather than get worried. So we'll be happy to be part of that course. And we are committed to not only getting good results, but with a right process.
Thank you so much, brother. Thank you. Thank you all for joining.
Thank you.